Hello, hello, and good evening. Welcome back to Principles of Accounting 2. I am your host, Dr. B. We've finally made it all the way to the end of the semester of the spring 2022. If you can believe it or not, we're here. The last day of the semester is this Saturday night, uh, April 30th. So, wow, yeah, we made it. Hey, pat yourself on the back. You survived another class with me. So that's great. Okay. And in fact, I did say this at the very beginning of the semester that this course typically the students do a little bit better than they did in the 201. And the reason for that is because the stuff that you learn in Principles of Accounting 2 is more managerial focused and more applicable, which is why I think a lot of students do a lot better in this course. So, quickly before we begin our discussion on capital budgeting, I do want to call your attention to the classroom, just for all of you who are keeping score. We're in Module 4. We made it all the way to week 7. I call it week 7, week 8. They're the same. Okay, so technically week 7 for chapter 26, which is on the capital budgeting. Just as before, you'll have a homework assignment. This one happens to be a quiz. You have 2 attempts, as always, on the quiz. It's 5 questions, true, false, multiple choice. There's the exercises to help you to apply what you've learned, and also the PowerPoint presentation that we're about to cover. So in addition to the quiz, we have the final exam due at the end of this week. I'd like you to take the quiz first, please, before the final exam. That's the reason why I dated it a few days before the final, uh, because I really want you to take the quiz before the final exam. The final exam, we'll talk about here after the chapter, but I want you to know that it covers chapters 22, 23, 24, 25, and 26. So basically everything from the midterm forward. So 22, 23, 24, 25, and 26. It's 20 questions, mix of true, false, multiple choice. There are no math questions on the final. And we'll talk more about it, but I just want to give you a preview of that and to explain that it's important that you do this chapter's quiz before the final exam. So let me jump into the chapter on capital budgeting. And I'll bring up a couple of examples that we talked about before because it's very relatable to this conversation on capital budgeting. And I'll also preface this caveat that there will not be many questions on the final exam from chapter 26. And the reason for that is this chapter, chapter 26, is more finance driven, more so than accounting. There are a couple of times where accounting and finance kind of relate to each other. And investing is more of a finance thing, more so than accounting. But it's important to understand like how we account for those investments. And that's why it's important that we talk about it, but I'm also not going to test you too much on it because there really is more finance driven than accounting. Besides half the stuff you won't remember. But I do want to talk about it from the perspective of break even. We had a conversation maybe a few weeks ago about, or something like that. Maybe it might have been last week. I think it was a few weeks ago on break even. The point of break even that we learned about a few weeks ago was the point where your revenue equal your expenses. That's break even. But it was also the point where I need to sell X number of units to break even, or I need to sell X amount of sales dollars to break even. we talked about break even from that perspective. And in today's conversation, I want to talk to you about break even from the point of an investment. And the investment could be we're purchasing a piece of machinery, or we're purchasing a new factory, or we're purchasing a new uh, vehicle, we're purchasing a new whatever asset, right? We're purchasing an asset, and we need to understand, well, how long do I use this asset for to the point where I've paid for the asset? Meaning, at what point in time do I recover the cost of my initial investment into this asset, like this big piece of machinery? Essentially, it tells us at this point in time, I've recovered the original cost of the asset. That's an important concept to understand, so we'll spend some time on that. We'll also talk about this concept called the payback period. Payback period means how quickly I will get the return on my investment, on the purchase of the asset. Yeah? We'll talk about the accounting rate of return, the internal rate of return, and this concept called net present value of money. Basically, we're just talking about interest rates and that kind of thing. Uh, and we'll talk about those concepts briefly. We won't go too deep because there are whole classes around the concept of net present value. But we won't go that deep in this class because this is more of an accounting class than it is a finance class. But it's important to understand the concept from the perspective of you're going to purchase an asset that's used to help the business to generate revenue, like a piece of machinery, and you need to know how long it's going to take for you to recover the cost of the initial investment. And also, as a business owner, you might be faced with a few proposals or a few different pieces of machinery that you're looking at, and which one to buy will yield you the greatest return. Those kinds of decisions you might be faced with. So that's why this conversation is somewhat important. So first, let's talk about capital budgeting and what it is. Capital budgeting is when the business establishes a budget for the purpose of investing in long-term assets. Simple. The word capital means investment into assets. Capital. Capital could mean physical cash. Oftentimes it does mean physical cash capital. Yeah, capital. Essentially, it's investment into assets, capital. We look at, in capital budgeting, we look at the amount of the investment that we're willing to make to purchase an asset, and we use that logic to evaluate different proposals. We decide which assets to acquire or sell, and we decide which projects we want to do. And all of that's part of the capital budgeting process. So it goes like this. There's 3 steps to capital budgeting. 3 steps. The first is the department or plant manager submits a proposal. So I want to bring you back to an example I gave you some time ago when I was in my hotel days, when I was the financial controller for the hotel. And the example goes like this. So one day, I'm sitting in my office, and the chief engineer, the person who's in charge of maintenance, comes to me and says, "Hey, the chiller's about to break." And of course, my first thing is, "What's a chiller?" I don't know. I'm not a technical guy. I don't know what a chiller is. So he goes, "Oh, the chiller is the thing that keeps this building cool during the summer and warm during the winter. It's like the big air conditioning condenser on the roof of the building." So, okay, that sounds important. I said, "Okay, so it's about to break." So I said, "Well, I'm going to need some proposals from you to decide what to do. Do we fix it or do we replace it?" So he comes back and he goes, "Okay, well, I got my proposals." And he gave me a couple options, ones to buy and how much to fix. So he completed step one, provided me with the proposals, whether to buy or to fix, or different ones to buy. Okay? So step one. And then I convened, step two, I convened a committee for the capital budget. We already had monies set aside in our hotel's capital budget. Typically, in the hotel business, or any business really, the capital budget's purpose is to have monies set aside for improvements, like hotel renovations. That's capital budget money, comes out of there. When your hotel renovates, they use capital budget funds. When your business decides to upgrade the computer system, comes out of capital budget funds. When your business decides to renovate the building, capital budget funds. When the business decides to purchase new machinery, capital budget funds. This is long-term planning, long-term planning funds. So the second thing I did is I convened my committee and I said, "Okay, let's sit down and look at these different options. Options to buy or to repair." And then we make a decision on which proposals we want to send forward to the board for the directors for approval. Not always easy, right? Especially when you're dealt with a situation where it's kind of springs up on you. It's like, okay, well, now we got to repurpose those capital budget funds that we were going to use for renovations, or we're going to hold off on the renovations for a year or so to use the money to buy a chiller. So, those kinds of decisions need to be made, and we do that through the capital budgeting process. So it's so important, and it's hard. It's hard to make the right decision when it comes to millions and millions of dollars decision on what to do. Why? Because there's so much risk. What if I made the decision to repair the chiller and then the repair doesn't work? That's a risk. That'll be without the heat, without the air conditioning. That's a huge risk. So there's a lot of risk involved in the decision. What if I decide to replace the chiller and it ends up costing way more than what we had budgeted for? And now all of a sudden, we're running a deficit. That's not good either. So there's a lot of risk involved, especially with these big dollar decisions. And you just have to be very cautious and seriously evaluate every proposal, every choice, every alternative course of action. You need to rank them. You need to evaluate the initial cost, the setup cost, of all of the related expenses. and you need to rank each proposal based off of their fit for the situation. And that helps to reduce the risk, but the risk still exists. So why are they risky? The outcome is uncertain, huge amounts of money, long-term commitment, and decisions could be difficult or impossible to reverse. So, so think of it. I go with the repair instead of the replace for the chiller. Outcome is uncertain. I don't know how long the repair is going to last. It costs a ton of money to fix it. It's a long-term commitment to keep an old unit. And if it don't work, do you think they're going to give me a whole ton of money to go buy a new one after I just try to fix the old one? No. Impossible to reverse. Or you think I'm going to get a refund? No. Very difficult. Very difficult. Very risky. Or if I buy the new chiller, I'll come uncertain. How long is it going to last? We don't know. Cost a lot of money, for sure. Long-term investment? Yeah, a chiller usually lasts like 20 years, so yeah, I would consider that long-term. And very difficult. You can't go trying to get a refund if you don't like it. No. They had to get a big crane, the big crane. If you've got a 20 or 40 floor building, you need a big crane to get the chiller. So very impossible to reverse the decision. So yeah, there's a lot of risk involved. So it's just so important that when you make any type of decision on a proposal, alternative, you really sit and evaluate the pros and cons to each one, and you think about the initial cost, the operating expenses, because you got to keep servicing it. There's so many factors involved, and so it's important that you evaluate those and rank the proposals based off of that information. That helps to somewhat mitigate the risk. Now, when you do make a decision, you need to really think about the cash inflow and outflow from the decision. So let's say you have a business and you manufacture products, and there's this new piece of equipment that will help your business to generate the same product quicker. Yeah, that's a great thing because the technology advancement helps the business to operate quicker. That means you'll be able to generate more units faster. All good things. But before you go and buy that piece of equipment that will help your business grow faster, you need to think about the cash inflow and outflow based off of the purchase of that piece of machinery. Because you got to remember, a lot of our investing decisions into property, plant, equipment are based off of our cash flows. Because the net cash flow typically gets used for capital investments or capital budget. So, when looking at the cash inflow and outflow, we look at the acquisition cost, the initial acquisition cost of acquiring the new piece of equipment. That's what we call the initial cash outflow. Oftentimes we call it year zero. Year zero is when the same year you acquired the piece of machinery is year zero. There won't be cash inflow for that piece of machinery because you're purchasing it. You're not using it yet. So we call that the initial cash outflow. It's the amount of money that you're using to purchase, install, and calibrate and insure and transportation, all that, the new piece of equipment. All of those things are the initial cost. So we call that an initial cash outflow. It's just money's out the window to purchase the equipment to get it to operating condition. Then when we start using the piece of machinery to advance the output of our units, it starts generating money. Okay, so because the more that your equipment is in use, the thought is, hey, I'm selling more. I'm making more units. I'm selling more units. So you're generating cash inflow from the revenue from the manufacturing of the additional units from that new piece of machinery that you got. So when we look at acquisitions of new piece of machinery, we look at the initial cash outflow purchase, the potential cash inflows each year from the cash that the machine will generate each year, and then ultimately we look at any salvage value if we decide to sell or dispose of the piece of machinery at the end of its useful life. So those are the kind of cash inflows and outflows that we look at when we decide to make a capital investment into purchasing a new piece of machinery. And all of that to say, if I go and make this investment with this new piece of machinery that will help me to produce more units over time, I need to understand what the payback period is. And the payback period tells me how quickly I'm going to recover that initial investment, that initial cost, that acquisition cost. How quickly I'll recover the acquisition cost. Payback period. How long is it going to take for me to recover the initial investment, the acquisition cost? That's what that means. Payback period. The formula is pretty straightforward. Okay, payback period formula. It's the cost of the initial investment, the cost of the piece of machinery, divided by the annual net cash flow. Annual net cash flow. Remember, net cash flow is calculated by taking the cash inflow minus the cash outflow. Cash inflow minus the cash outflow gets you net cash flow. Cash inflow, cash in, minus cash out equals net cash flow. So we take the cost of the investment, acquisition cost of the machinery, divided by annual net cash flow to get me the number of years, or months, years, it will take me to recover the initial investment, payback period. And we look at, when we're making a decision between multiple proposals, multiple options of machinery, machine A versus machine B or machine C, which one I want to purchase. The decision's oftentimes made based on the payback period. The shorter of those payback periods will likely result in me purchasing that machine. If I'm going to recover the cost of the machinery quicker, I'll probably buy that one versus the other proposals. Now here's an example. So we're looking to buy a new piece of machinery. The cost is $16,000. It has a useful life of 8 years. It has a salvage value of 0, meaning when I decide to sell it at the end of its useful life, it's not worth anything. I expect to be able to make 30,000 units with this piece of machinery. And the average sales price per unit that I make with this piece of machinery, I usually sell those for about $30 a piece. Let's calculate the payback period. Now, the payback period, of course, is the cost of the initial investment, $16,000, divided by the annual net cash flow. Well, we have to calculate annual net cash flow. And if we do that, saying that our cash flow will be the same amount every year, which we know that's not always the case, but for this example, say it's the same amount of net cash flow every year, how much would that be? So, well, we need a little bit more information. So, how we come up with 4,100? Well, if our sales price is $30 and we are going to produce a total of 30,000 units, and we're going to do that for 8 years, we get to the 4,100. Now, because it's even net cash flows. We didn't mention anything about expenses in this example, but we know what our sales would be. If it's $30 a unit, 30,000 units divided by 8 years, so 30 times 30,000 divided by 8, getting us to the 4,100. We can see that we would recover that initial $16,000 in 3.9 years. So cost of the investment divided by annual net cash flows. Make sense? Good, right? Okay, excellent.
I'm here, Professor.
Mike, all right, very good. Okay, now let's look at an example, the same example, but this time let's look at it from the perspective of unequal net cash flows. Because in most businesses, you're not going to receive the same amount of cash flow every year. It's just not normal. Usually it's a little more, a little less. It depends on the kind of year you had with your sales. Unless, of course, you have like a government contract, then it might be the same amount every year, which is why we have the even cash flow example. That's if you just sell to the one customer, the government. But in most businesses, we have good years and bad years. So let's look at it from the example of uneven cash flows. Now you can do this simply with an Excel spreadsheet. Just simply run it through your 0 to 8, your expected net cash flows, and then run a column, the second column, adding up the net cash flows, cumulative net cash flows. So year 0, it's a minus 16,000. Why minus 16,000? Because at year 0, that's when you bought the piece of machinery. You haven't started using it. You just bought it. All right. So minus 16,000. Cash went out to buy the piece of machinery. And then we start making some money. So year 1, we made $3,000. So that means our cumulative net cash flow is minus 13. Why minus 13? Because it's minus 16,000 plus 3,000, which makes it minus 13,000 total. Year 2, we made another $4,000, which means our cumulative is minus 9,000. Why minus 9? Negative 13 plus 4 equals minus 9. Year 3, we made another 4,000, so now we're at minus 5 cumulative. Year 4, we made another 4,000. Now we're at minus 1. Okay, so we're getting closer to 0, right? We're getting closer to 0. That's good. It means we're getting closer to break even. Year 5, we made another 5,000, which means we're now at a positive 4 for the net cash flow. Okay, we broke even. Okay, now where did we break even? We broke even between years 4 and 5. Where exactly between years 4 and 5 did we break even? So the formula for this is we know it took 4 years. Plus 1,000. Why plus 1,000? Because that's what the cumulative was minus 1,000. If we add 1,000 plus 4 years, that's the point of break even. So 4 years plus 1,000 divided by $5,000 from year 5. So 4 years, 4,000 plus 1, 5,000. We see 4.2 years. 4.2. 4.2 means 4 years and 2 months. So that's one way of looking at it. I prefer just use Excel. Just run it out in Excel. Easy. There's positives and minuses with this approach to evaluating the investment decision. The positives are we're using cash flow and not income. That's good because it's cash that we'll use to purchase it with, and it's cash that we'll generate from the piece of equipment. And the second positive of using this approach is that it's easy. A couple of negatives, though. One is that it doesn't take into consideration time of the net cash flows. It also ignores the point at which you reach the point of break even from an exact perspective. It also ignores the time value of money. The reason why time value of money is a negative on this, for using this example, is it doesn't take into consideration interest. I could be making interest based off that investment. So, or I could be losing interest in terms of if I were to finance it. So, from that perspective, this approach, while it's good for ranking purposes in evaluating different proposals, it's really not the best when it comes to being exact from that perspective. Okay, so we'll switch gears briefly. Now we're going to get a little bit more finance focus, but now that we understand the payback period method, I also want you to understand the purpose of looking at something like the accounting rate of return when it comes to ranking and evaluating different proposals for the investment decision, purchasing a piece of equipment or whatever. But the accounting rate of return helps us really to do a few things. It helps us when it comes to comparing, and also helps us to understand the risk that the company is willing to take. What I mean by that is the accounting rate of return is kind of like saying, hey, this is the company's internal rate of return for investing. Meaning, how much the company needs to get back in return. How much the company needs to get back in return from their investment. Right? So it's similar in nature. It's similar in nature to the internal rate of return, which we'll talk about. It's basically like saying, hey, if the company decides to do this, we need to get a return on the investment, and the return should be some percentage. And so how do we calculate that percentage? How do we find the accounting rate of return? We use this formula. It's the after-tax net income divided by annual average investment. How do you find average annual investment? Well, there's two ways to find average annual investment. The first and the simplest is by taking the beginning book value plus the ending book value divided by 2. Remember, book value is the value of the investment. The value of the assets that you have, your assets. Beginning book value. book value. It's the value of the assets. Beginning book value plus ending book value divided by 2. Those are found on the balance sheet. The other way of calculating the annual average investment is by taking the sum of individual years' average book value divided by the number of years of the planned investment. Nobody ever does that. Textbook does that, but in practicality, the first method is easy. And again, the accounting rate of return really is designed for simply comparing different investment decisions. It helps the company to understand its risk tolerance, especially when it comes to rates of return. The higher the rate of return, the better, of course, and that's usually the preferable investment. So if we look at our example of buying that $16,000 piece of machinery, I can calculate the accounting rate of return. So the book value of the machine, 16,000. It's new, right? That's why it's still worth 16,000. Plus ending book value, 0. Remember that it's not going to be worth nothing at the end. Divided by 2 will give me $8,000 for the average investment. So now we plug average investment into our formula. So we take annual after-tax net income divided by average investment. So 2,100 divided by 8,000 gets me 26.25% accounting rate of return. This is very good. This is very high. Okay, that is good. 26.25% is if I were making this decision and I was using accounting rate of return to make this decision, I would probably make this investment into this piece of machinery. Why? Because 26.25% is really high for rate of return, and that's really true with any rate of return. It's very high. If I saw one that high, I'd probably make that decision. But I know better. I know better. Don't make an investment decision just based off of the rate of return. This is a terrible way of investing. Okay, rate of return, it's nice, but there's so much risk. And the same is true, like for those of you who are interested in, stocks, purchasing stocks, or if you're like you're looking at your retirement fund and you're making decisions on different funds. Oftentimes they'll publish the rate of return. Sometimes it can be a little deceiving because the rate of return does not take into account future risk. And so, from that perspective, it's important that you get more information and use more information to make an investment decision before you don't just use rate of return as your decision making process. Use more information, like look at the company's dividend rate, look at their previous performances, etc. Don't just base it off of 1%. So, and with that, a couple of weaknesses using accounting rate of return, it ignores time value of money, meaning it ignores any potential interest or interest payment for that matter. It also focuses only on income and not the actual cash flows, so that's relatively problematic. And if the income is different from year to year, the project might appear to be more desirable in some years and not in others. And so that could lead to an incorrect decision being made on the purchase of this piece of machinery. So there's risk. That's all I'm getting at. And the third one I want to talk to you about is the concept of net present value of money. Net present value of money takes into consideration things like the interest rate and the good old, I call it the good old saying, a dollar is worth more today than it is tomorrow. And the reason why a dollar is worth more today than it is tomorrow is because you can invest that dollar and you can earn interest with that dollar. And it'll earn interest starting today, compounding interest. So, just a couple of things to think about when we talk about net present value. So, when we look at net present value in the purchase of a piece of machinery, we take into consideration future cash inflows and outflows that will benefit the company over time based on the purchase of this piece of machinery. So we're projecting forward, yeah? So there are two steps to calculating net present value. First step is you take the discount of the future net cash flows from the investment at the time of the required rate of return. And then you subtract the initial investment from the sum of the discounted cash flows. It sounds complex. It is complex. But I'll tell you, a financial calculator will quickly and easily do this for you. You can use a financial calculator on the internet, or you can purchase like a BA2 Plus or whatever. But a financial calculator makes these types of calculations very easy. Also, Excel has the net present value formula built in. So that's another quick and easy way to do the calculation. Almost no one does it longhand anymore. That almost doesn't exist. Oh, I'm sorry, I should have mentioned this. The required rate of return. This is the company's internal rate of return, meaning this is the percentage that I need in order to make this investment possible. We call this the cost of capital. Raising capital is not free. What do I mean? In business, there are two ways to raise money. Okay, especially when the business is just getting started. There's two ways to raise money. Number one is you take out loans. That's the financing part. And the second is you raise equity. Equity. You have equity and you have finance. A lot of businesses use a combination of the two. And this is oftentimes how the internal rate of return is established. I'm not going to go too far down that rabbit hole because that's a finance class all in itself. This is not a finance class, but I just wanted to help you to understand how the internal rate of return is established. But oftentimes it's driven based off of a combination of the rate of equity and the rate of financing. There are charts, okay, and this is taken from a net present value chart. These charts are typically established by the banks or by the Federal Reserve. These rates, the net present value rates, help us to understand the point of recovering the initial investment from the payback period based on present value. And so if we look at our example, purchase a piece of machinery for $16,000, has a useful life of 8 years, salvage value is 0. We can look at the cash inflows projected we know that the company rate of return 12%. So we look at the present value of $1 at 12%. We take the net cash flow, multiply that by the present value of $1 at 12% per year to equal the present value of the net cash flow. Now we run that out for 8 years, and we can see that at the end of 8 years, we take the total minus the initial investment will give me the net present value. Now, this approach is very useful. It's relatively complicated to calculate, but it really is an important way of using present value in understanding the investment. Because the concept of the time value of money is that there is interest involved, and there is the internal rate of return involved, and all of those are really important factors when making investment decisions. And again, if you wanted to run something like this out, Excel is your friend. So if I were the company, I would make this investment decision. And why? Because any time that the net present value is greater than 0, it's usually a pretty good investment. This is the decision tree. If net present value is greater than 0, we make the investment. If it's less than 0, we do not. So yeah, I mean that's the concept of this. And we usually look at net present value along with those other methods we talked about in the ranking process when looking at different investment decisions or proposals. And this one, net present value, this is kind of represented graphically. Your cash inflow each year using the table to establish the value minus the investment to get the net present value. Just kind of shows you graphically. It's simple when it's shown graphically, but it's represented this way. When we have equal payments of anything, we call that an annuity. I'm sure you probably know that already, but we call it an annuity. An annuity is equal cash payments. We receive, when you receive Social Security, if it's still around when you retire, if you receive Social Security, it's called an annuity payment. If you receive retirement regularly from a retirement investment account, that's called an annuity payment. When you pay your mortgage, that's called an annuity payment. When you pay, your car note, that's an annuity payment. It's a series of equal payments over time. That's what an annuity is. So anytime you hear the word annuity, that means equal payments over time. Whether you're paying it or you're receiving it, it's called an annuity. In accounting and in business and pretty much everything else we do in life, automation is really driving down cost. And in some cases, driving cost up, depending on what it is, really. But in most cases, robotic process automation is driving costs down in business. It is reducing redundancy in labor and it's reducing labor cost, which is good. And in business, sometimes we purchase machines that do repetitive tasks. One of those pieces of machinery is called a CNC machine, computer numerical controlled machine. In other words, somebody programs the machine and it will do the repetitive task like drilling holes or making holes in steel or whatever it's designed to do. And it reduces labor costs because the machine just takes over. Somebody programs it, it takes over, so it reduces labor costs. So here's an example. Our company wanted to purchase a piece of machinery that costs $8 million. Its design is to automate and reduce labor costs. And so we can calculate net present value based off of the net cash savings that we have in our bank account. If I save that for the 8 years, and the annuity rate is 10%, I look at the present value being 6.14 at 10% using a table. I can get present value net cash flow is 9,216,000, which is greater than the initial investment. So if I take the projected cash savings over the 8 years minus the initial investment to get the net present value of 1.2 million, I would say that purchasing this piece of machinery is a good investment, and to do it because the net present value is greater than zero. And here's an example of using that concept of net present value with uneven cash flows over the years. And we use a table, of course. But again, I'm not going to, in this class, I'm not going to ask you to make these kind of calculations because they get very complex. That's more for a finance class. But again, the reason why I'm showing you all of this is to help you to understand that we use things like net present value, the payback period, the other concepts to help you to understand how to rank, compare, and index projects, proposals, all those kinds of things. It's so important to understand that concept because it helps you when you're faced with multiple decisions or multiple options, I should say. It's a great way to help you to rank those options and find the best one for the company's needs. And one of those methods is also using the profitability index. Profitability index will help you to make the best possible decision. And this one's a pretty straightforward formula. It's the present value of net cash flows divided by the initial cost of the investment. And so the example below illustrates three potential investment opportunities into machinery. So the way it works is we take the initial investment divided by the cash flow to get the profitability index. So the cash flow divided by the investment to get the profitability index. So there's three of them. One is 1.2, 2 is 1.5, 3 is 0.9. Well, I wouldn't even consider option 3 because it's below 1. If it's below 1, it's not a feasible investment. Number 1 is nice, but it's not as good as number 2, 1.5. The higher the profitability index, the better. And that's why we use profitability index in our ranking of looking at different proposals. So less than 1, no way. Out of these two, 1.5 is the best. Higher the better. when we make decisions to purchase something like machinery or any other type of assets, it's so important to ration your capital. Capital rationing simply means we're controlling the flow of our capital investing. That helps us to the point where we're not investing too quickly or too slowly. We're rationing it. Yeah? It helps to control the flow of capital investing. That's what capital rationing means. They're arbitrary forces that we impose on ourselves to control the spending. And so there's hard rationing and soft rationing. Hard rationing is when there are external forces controlling our investing decisions. And there's soft rationing. Those are the rations that management is putting on ourselves to control the flow of capital investment. And the last one is the internal rate of return. The internal rate of return, as I had said earlier, is that that internal percentage that I need in order to make the investment. We do this based off of the interest rate, and we look at the present value of the inflows, cash inflow, minus the initial investment. If it's greater than zero, then that's good. The net present value should be equal to zero. That's good. That helps us to establish internal rate of return. So there's two steps to establish internal rate of return. We compute the present value factor, and then the second is identify the discount rate. In this example, we have a project. The initial cost of this project is $12,000. It will last us for 3 years. We expect to yield a cash inflow of $5,000 per year. So we establish the internal rate of return. The initial cost divided by the cash inflows equals 2.4. 2.4 present value factor. We take present value factor, we find present value factor on the 3-year horizon on the annuity chart. 3-year horizon, period 3. 2.4, we find it on the chart. That means that our internal rate of return should be 12%. The same method can be applied using uneven cash flows. We're not going to dive too deep into that. But again, if the internal rate of return is greater than zero, we make the investment. If it's less than zero, we do not. We talked about the payback period, the accounting rate of return, the net present value, and the internal rate of return. This chart helps us to summarize the differences between those 4 methods. In looking at all of those methods, it's important that we as managers look at all 4 methods when making a decision on investing in a piece of equipment or whatever other investment decision we're making for the purposes of capital budget. And that's really the overall premise of why we do these kinds of things. Looking back, it's so important to know when we break even. You know, we talked about this during the payback period. And understanding the point of break even is understanding the point of the payback period. When we reach the point of zero under cumulative present value cash flows, we've reached the point of break even. Point of zero is break even, also called the payback period time. But using Excel, as I had said earlier, so easy. It makes your life a lot easier anyway. When calculating something like net present value, you can also calculate, of course, the internal rate of return. There's a lot of other finance functions there as well. But what you do is you take the initial investment in terms of minus, and then you go the useful life years 1 through 8. You project out what your net cash flows will be, and you plug it into the net present value formula in Excel. It'll pump out that information. You do the same thing with the internal rate of return. Very, very easy. So that's why technology is good. Okay. My friends, we've made it to the end of our course. This is the end of chapter 26, which means the end of the course. First, I want to ask you, are there any comments, questions, or concerns about anything we talked about today with respect to capital investing or any of that fun stuff?
Professor, normally on the assignments, it'd be like chapter 26 and 25, right? So I seen when you first went over it, it said chapter 26 exercises and a chapter 26 quiz. The exercise portion, is that graded or it's
No,
just practice
no,
for the quiz?
no, Mike. So the exercises, they're just there to help you. So you
Okay,
don't need to submit those. That just helps you to practice it, right?
okay,
Chapter
gotcha,
26, chapter 26 quiz is what gets submitted. Uh, so yeah, good question.
gotcha.
Chapter 25 was last week. So
All right, cool, cool. Thank you, Professor.
absolutely my pleasure, Mike. Good question. Any other questions? Okay.
The final is due Sunday, correct, Professor?
Saturday.
Saturday.
Saturday. Yeah,
Saturday.
last day of the semester is Saturday, not Sunday. Yeah. Yep, I know. We're there. Okay, and with that comment, I do want to quickly talk about the final exam. I'll be posting a second video on the final exam as well. So let me go ahead and stop this part of the recording.